This chart shows the survival rate of newly issued tokens from the previous market cycle. Within 3 months of trading, 95% of these assets permanently lost their initial listing price. Even among the remaining 5%, the projects classified as blue-chip market leaders suffered. Over 12.5% of those top-tier issuers have now ceased operations entirely. The market model built on geographic ambiguity, regulatory arbitrage, and unbacked speculation has collapsed. Early crypto regulation was largely reactive. It was driven by massive, unrecoverable exchange hacks that left consumers with zero legal recourse or financial protection. That environment has been replaced by strict codified oversight. In early 2025, the SEC formally rescinded Staff Accounting Bulletin No. 121. This single regulatory shift allowed Tier 1 U.S. financial institutions to offer compliant custody for digital assets, facilitating the entry of billions in dormant institutional capital. Global tax authorities followed suit. The IRS now strictly treats digital assets as property. Centralized platforms are mandated to issue Form 1099-DA reports for all asset disposals, forcing startups to integrate sophisticated on-chain forensic accounting tools to maintain real-time compliance. Consequently, the capital base is migrating. Investors are abandoning generic decentralized finance yields in favor of institutional, on-chain, real-world asset tokenization, a sector projected to surpass $26 billion by late 2026. A cryptographic token is a highly efficient mechanism for value transfer and governance coordination. It is not a standalone business model. Building a resilient Web3 enterprise now requires engineering across 3 distinct architectural pillars. Founders can no longer outrun multi-jurisdictional law. Survival dictates that strict legal compliance must be coded directly into the bedrock of the cryptographic architecture itself. Directly tokenizing the shares of a parent operating company introduces severe, overlapping liabilities regarding cross-border taxation and shareholder rights. Native token issuance is legally toxic. The established standard to solve this is the legal wrapper model, forming our first pillar, corporate architecture. Under this model, a startup maintains a traditional capitalization table legally, but mirrors this table exactly on a public blockchain through an intermediary entity. Startups typically incorporate these intermediaries as special purpose vehicles, or SPVs, in cooperative offshore financial centers like the British Virgin Islands or the Cayman Islands. For the Asian markets, the dominant framework is the Japanese Godo Kaisha Tokume Kumii, or GKTK structure. This acts as a highly flexible bankruptcy remote vehicle, perfectly suited for holding tokenized real estate or corporate trust assets. The mechanics are straightforward. The legally binding physical shares of the startup are transferred to the SPV. Instead of the parent company issuing tokens, the SPV issues specialized security tokens that represent a legally binding, digitized claim on those locked physical assets. These security tokens predominantly utilize the ERC 1400 standard. The ERC 1400 standard is a specialized suite of smart contracts designed for securities that supports embedded identity tagging in programmatic transfer restrictions. This ensures secondary market trades only execute between wallets that have passed rigorous Know Your Customer verifications. If the digital ledger drifts out of sync with the physical register, it creates immediate unintended equity dilution. To prevent this, startups utilize cap table as a service platforms to mathematically guarantee the total token supply exactly equals the authorized physical shares. By deploying a legal wrapper SPV, founders transform regulatory compliance from a paralyzing liability into an automated institutional-grade moat. Our second pillar addresses the internal logic of the network. Unlike traditional equity, native utility tokens behave strictly as sovereign digital macroeconomies. Many early projects fell victim to the sustainability paradox. They built economic models dependent on transaction fee revenue derived entirely from speculative trading. When speculation dried up, those fee revenues collapsed, rendering their treasury allocations useless. This formula is the equation of exchange, a macroeconomic model linking total transaction volumes to asset price. It states that the money supply, M, multiplied by the velocity of money, V, must equal the price level, P, multiplied by the total transaction volume, Q. The primary culprit for a token's collapse is unmanaged velocity. If users buy a token only to immediately spend or liquidate it, velocity approaches infinity. Mathematically, this extreme velocity forces the token's price down, regardless of how high the network's transaction volume scales. Startups attempting to bootstrap early liquidity often fall into the VC trap. Predatory venture capitalists demand opaque token warrants attached to standard equity rounds, granting them massive percentages of the future token supply at exceptionally steep discounts. Historically, projects released these insider tokens in massive quarterly unlocks. Algorithmic trading bots would routinely front-run these known dates, shorting the asset and extracting millions in risk-free profit while decimating retail confidence. The mathematical defense against this extraction requires forcing a strict 4-year vesting schedule on all early investors, protected by a minimum 1-year cliff. Following the cliff, tokens must be released through continuous block-by-block streaming emissions to neutralize predictive algorithmic dumping. You avoid extractive venture capital by intentionally bifurcating your capital stack. Offer traditional, legally binding equity to secure institutional funding, while reserving network tokens exclusively for community engagement and decentralized governance. Founders are scaling this approach through democratized venture syndicates like IPO Genie. These platforms lower the institutional entry floor from hundreds of thousands of dollars down to roughly $2,500, allowing startups to raise substantial capital directly from an aligned active user base. Furthermore, massive ecosystem grant programs provide non-dilutive capital to build proof of concepts. Entities like the UNICEF Venture Fund distribute up to $100,000 in equity-free funding to accelerate protocol growth without forcing founders to surrender early governance rights. A durable protocol ecosystem is engineered by systematically suppressing token velocity and democratizing initial capital formation, completely bypassing the hazards of early-stage hype. As the startup decentralizes control to an autonomous organization, the corporate treasury shifts from a fiat bank account to a publicly verifiable on-chain matrix. This brings us to our final pillar, treasury defense. Managing hundreds of millions of dollars in highly volatile digital assets requires the PALO framework, standing for preservation, alignment, longevity, and optimization. This framework explicitly prohibits idle capital, while strictly forbidding aggressive, highly leveraged yield farming. When a DAO liquidates native tokens to fund operational expenses on standard automated market makers, it broadcasts its intentions to the public ledger. Predatory maximal extractable value bot networks instantly detect these large orders, executing front-running and sandwich attacks to artificially manipulate the price, milliseconds before the DAO's trade clears. This is compounded by loss versus rebalancing, or LVR. LVR occurs when external arbitrageurs systematically exploit the price difference between centralized markets and an on-chain liquidity pool, silently siphoning off an average of 5 to 7% of the pool's total value every year. Leading treasuries counteract this bleeding by migrating to intent-based trading architectures, like the COW protocol. Instead of executing an exposed market order, the DAO cryptographically signs a secure intent to trade. Professional third-party solvers then compete in a closed batch auction to find the optimal execution path. This structural shift neutralizes MEV extraction. Yet, the most critical operational hazard facing treasuries in 2026 sits at the intersection of decentralization and artificial intelligence, the prompt injection attack. Malicious actors embed invisible, logic-altering commands inside ostensibly legitimate public grant proposals. When a DAO utilizes an autonomous AI agent to analyze the document, the hidden prompt overrides its base logic, commanding the agent to automatically execute a fraudulent treasury transfer. DAOs must completely abandon fully autonomous AI execution. Defense requires platforms like SAFE, which enforce strict human-in-the-loop cryptography. An AI may initiate a transaction, but a human cosigner is mathematically mandated to verify the logic before any capital moves. In an environment teeming with predatory algorithms, automating your treasury is a fatal liability unless constrained by absolute human cryptographic verification. The scaling of a tokenized equity business requires extreme, multidisciplinary engineering. A successful founder must simultaneously act as a nuanced regulatory diplomat, a rigorous macroeconomic architect, and a paranoid cybersecurity specialist. Large-scale legislative frameworks across the EU and Asia function as institutional filters. They remove illegitimate competitors, providing a clear path for the trillions of dollars managed by regulated corporate treasuries to move into compliant protocols. As the market reaches maturity, competing strictly on blockchain performance metrics, like transaction speed or base compute costs, is no longer a viable strategy. Moving capital between highly public chains is trivial for users. However, integrating zero-knowledge privacy and secure data architectures creates deep ecosystem lock-in. While bridging public tokens is easy, bridging cryptographic secrets is exceptionally difficult. Privacy is the ultimate competitive moat. The phase of legally ambiguous experimentation has reached its functional limit. Long-term value now scales by anchoring digital innovation to the bedrock of compliant, generationally durable architectures.